Well, hello everyone, and welcome to our webinar today on predatory lending, every client's worst nightmare. Our guest today is Susan Lupton, and I just could not be any more excited about any webinar than to have Susan here to explain this really important topic and to share her knowledge with us. And she does have a lot to share and to teach us today. I will give you her bio in a few minutes as I hand over the webinar to Susan. So, just so you have a sense of our agenda, we're doing a welcome and overview. I'll let those of you who are new to financial social work know a little bit about us. And then I'll introduce Susan, who will do our webinar on predatory lending. Following that, I will just do a slide or two on the financial social work certification and our client program, so you know the contribution we make to helping clients take control of their money and gain control of their lives. And then we will stay with you and answer your questions. So, what is financial social work all about? Well, our mission is to help men and women begin the journey to sustainable, long-term financial behavioral change. And I probably have a slide for a couple of slides down that talks about the fact until and unless behavior changes, nothing changes. So therefore, we need a behavioral model. And the work is all about helping men and women and contributing to personal, professional, financial, and social change. And certainly the work that Susan does and that the Center for Responsible Lending does, the organization that she works with, is all about social change. At its core, financial social work practices the basics of all strong social work. It's about societal change. It's about having good ethics and values. It's about social justice, human rights. And in case you're wondering, I did not paint those stones. Nope. So here's what it looks like. It's your relationship with your money that drives your financial behavior. And this is where change happens. We have to know and understand why we are where we are financially and recognize what do we need to do to change our financial behavior. And when we change our behavior, we inevitably and most importantly and wonderfully improve our financial circumstances. So I created this little formula a number of years ago, and that really, I think, simplifies what it's all about. Because taking greater responsibility for your financial future requires more than just new financial skills and tools. Those are important, but this is a process. Changing behavior is an absolute process, and financial stability is a very personal, individual, and emotional choice. The key word, choice. We have to help clients understand what's in it for them. And when we help them understand why they are where they are and where they want to be in the future, we have engaged them. And the financial social work model is ongoing education, motivation, and support. And that's how we do it. So our interactive, introspective model is heavily psychosocial. And here you see it again. Until and unless behavior changes, nothing changes. So this is just a slide of a few of our agencies and clients around the country, just to get a sense of where our students and our graduates are working and what they're doing. Those of you who have been with us in the past at our webinars, and we've been doing them for many years, know that I try really hard to make them as interactive as possible, and we very often do a lot of polls. But since we have such a wonderful guest speaker, I decided that rather than pass the presentation back and forth to give you the polls, I would start the polls, do a few of them right up front, and this will help Susan get a sense of where you're all at, because while I'm sure she'll explain that the Center for Responsible Lending is here in North Carolina, they do concentrate on North Carolina, but they are very involved in everything that's going on around the country, and she thought she would like to know where all of you are. So let's find that poll, and we'll get started. I have to open it, and here we go. So, where do you live? Let's launch that and get a sense of where our audience is located, Susan. While they're doing that, Susan, I guess you could say hello. I'm sorry.
Hi. I didn't realize people could hear me. Absolutely.
Okay. Interesting. Okay. Okay. So 78% of you have voted. 80%. I'm always looking for 100%. Once in a while I get it, but I'm going to count this down 5 seconds. And if you want to vote, go ahead. And after that, I'll just share it with you. We're at 86%. Anybody else want to come on in? Okay, we're almost at 90%. 5, 4, 3, last chance, 2, 1. Okay, so, there we go. 89% of you voted, and this is where you're at. Interesting. So, I guess we're not fairly evenly spread out, but our heaviest concentration is in the South, obviously, and Northeast and West, equally represented. I'm curious where the other 2% are. If you want to write that into the question box, I can share that with everyone. Okay, so thanks, everybody. Now, I'm going to hide that one and move on to the next one. I have 4 for you. So do you think payday loans serve a purpose or fill a need for clients who have no other options? And as soon as I get my mouse on here, I will. Okay, launch this one. What do you think? I'm interested in this one because this is a conversation I had with Susan. Is this the right one?
That's a different one. There you
go. Okay, well, okay, so I showed you the wrong, I clicked on the wrong one. So we'll just do this one. Okay. Can you see the question, Susan? I can't see the question.
The question is, which of the following are legal in your state?
Okay, great. And you should...
Car title.
And you should be able to pick more than one choice if I did this right. So, okay. Well, we have a knowledgeable group, Susan. I can tell you that. Yeah, a lot of them know what is happening. So, anybody else want to vote? Okay. Very interesting. Okay, the one thing we can't tell, of course, is where you're located. So I just thought it would be interesting to see this one. 82% of you have voted. I'm going to close this poll and share it with all of you. And 76% of you say that payday lending. Does that sound right to you, Susan?
It's probably not too far off, yes.
Well, I guess based also on where our audience said they were located, you can probably tell that. Okay, yes. So a quarter of you say that you know banks are making payday loans. Okay, let's close that one and see if I can get the right one this time. Do you think payday? Okay, here it is. So this is the one that I discussed with Susan early on. I was harassing her somewhat, trying to get her to do this wonderful presentation for us. And she came through, and I'm so excited. So I just have one more poll, and then I'm turning it over to her. But this is kind of from the the worker, social worker, staff person perspective, because this is a question I asked Susan very early on. Okay, 60-some% of you have voted. If you want to vote, go ahead, and I'll count it down. 5, 4, 3, 2, 1. This is interesting. Okay, I'm going to close it. We're at 80%. Anybody else? Okay, I'm closing it. Okay, you're still voting. Okay, we got 82%. Okay, here it is. So you're probably going to learn something today like I learned something from Susan, because I was not in that. I was not as totally in that no situation. But boy, if I had one that said never, 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 Susan got me there. So, okay. But it's all personal. I know. Okay. And last one. Okay. Okay. And here is the last one. And then we're going to go ahead and turn it over to Susan. So what is the average APR on a payday loan? Well, again, we have a very knowledgeable group. Huh. Interesting. Okay. And you are all getting in on this one. You're not going to wait and be closed out. Okay, come on. 84% of you have voted. Anybody else? You know it's all anonymous. We're just trying to get a feel for where you're at. Okay, 86%. Come on, give me a record break. Give me 90. Nope, nobody wants to have some fun here. Okay, not a fun topic, but it's always. Okay, 87%. 5, 4, 3, 2, 1. I'm going to close it and share it. And of course, the 42% of you know what you're talking about. The rest of you are going to learn a lot today. And every time I talk with Susan, I learn a lot. So I might as well turn this. Okay, we already did this one. But yeah, isn't that great graphic? It is a trap. So this is the website for the Center for Responsible Lending, and you are going to want to register and follow every time they put out a newsletter. We tweet about all the articles because they're so great. Okay, so meanwhile, I am handing this off to Susan. Okay. Okay, I need to hide this, I guess. Okay. Okay, Susan, are you good?
I'm trying to change it. It hasn't shown up yet.
Really? I see your screen.
Oh, you do?
Mm-hmm.
Cool. Okay. Well, let's try it again. I see my screen with yours on top.
Yeah. How did you get out of that before? Just so
I don't know.
you want to quickly close your screen and relaunch your PowerPoint?
Screen sharing is now paused. Let me just see if it shows up. Show my application, show my... Let me try this.
Just so you all know, we rehearsed this, and we've done all kinds of trial runs, but technology...
Oh, here it is.
Okay, there you go. Go ahead.
Yep.
Oh, wait, let me tell everybody. Susan Lupton is Senior Policy Associate at the Center for Responsible Lending in Durham, North Carolina. CRL is an affiliate of Self-Help and a policy and research organization dedicated to protecting homeownership and family wealth by eliminating abusive financial practices. And she is also the project director for the North Carolina Coalition for Responsible Lending. Susan, thank you for being here.
Thank you, Rita. Glad we're getting started.
Okay.
Welcome, everybody. Thank you so much for calling in. I will say just a minute about the organization I work for. As Rita said, Center for Responsible Lending is really focused on getting rid of predatory lending practices. We are a policy and research group, but we're part of the Self-Help Credit Union and the larger Self-Help, which is one of the largest community development financial institutions in the country. Self-Help has made over $6 billion in loans to 74,000 families and organizations. We focus on lending to low-income families, people of color, women, and rural residents. So this is an overview of what I want to cover today, and I hope that by the end of this session you will have a pretty good understanding of how these high-cost consumer loans trap borrowers in debt and sort of what the consequences of that are. I want to talk about payday lending, banks making payday loans, which is a fairly new phenomenon, extremely upsetting and scary, and also car title loans. And I will look at the research, and we'll also talk about sort of policy changes that are happening at the state level and at the federal level to rein in some of these abuses. So it's going to seem like initially that I really talk a lot about payday lending because that's because actually if you understand payday, then bank payday and car title are just sort of close cousins, and you will understand those quickly. So even though you feel like I'm going to be talking about payday a lot, we will get to the other two products as well. And certainly pipe in with questions and concerns, and Rita will feed those to me as well. So, seemed like most of you are familiar with payday loans. Most of you understood that they were expensive. Some of you thought that they were sometimes helpful on occasion, maybe helpful, not sure. So let's look at some of the research on this topic. So first, a payday loan is a very small consumer loan. The average size is $350. You secure the loan by writing a personal check that comes due, it's post-dated, and it comes due on your next loan is repaid in full in one single payment, usually 2 weeks later, and the average APR on payday loans is actually 400%. So it's higher than we even put on the available choices. Now, payday loans, you probably think of them often as being offered in storefronts or over the internet, but we will also talk about the banks that are making payday loans as well and how those work. This, I think, is probably the most important slide I have. And this gets at the fact that payday loans are actually designed to trap borrowers in debt. This is, if a borrower takes out a loan, if they took out a loan and they were able to pay it back in 2 weeks, and they paid $15 per 100 to borrow that money, we really wouldn't care. We would say, okay, expensive loan, but it's probably a reasonable alternative and it's not a big problem. But that is just not what happens. That almost actually never happens. The business model is really designed to keep people in debt over the long term. So this isn't an unhappy consequence for a few unlucky borrowers. This is the norm, and this actually is the intention of the lenders as well. They structure the loan to be unaffordable, and by making it unaffordable, they keep you in debt as long as they possibly can. And here's how that works. So, and I think everybody has a sense that they understand how payday lending works, and, including me when I first started working on it. But once you really dig in and talk to a lot of borrowers and sort of see the decisions that they're going through, and also look at the research about the loans, you come to a somewhat different conclusion. So this is what we call the cycle of repeat borrowing. We also call it the debt trap or the cycle of debt. And as I said before, this is the heart of the problem with these loans. So I want to spend a few minutes just to make sure that you understand how this debt trap works and what factors sort of lead to this debt treadmill of taking one loan after another loan after another loan. So as you can see from this chart, the borrowers, initially, I would say, desperate for quick cash. So they go to the payday lender and they get a loan. They write their personal check. They post-date it for usually about 2 weeks later, their next payday. And as soon as they receive their paycheck, and as soon as their paycheck hits their account, their bank account, the payday lender cashes their check and repays the loan plus the fee. So if they borrowed $300, 2 weeks later they owe back $350. So they've just paid the payday lender back $350 on their payday. So their paycheck, in essence, is now short $350. They have $350 less to make it until their next payday. So understandably, they don't have enough money to pay their bills and other obligations, and they fall behind again. So after this happens, then where else can they go for quick cash? They can go back to the payday lender, of course, which the payday lender encourages them to do, and they go back either immediately or possibly, a little bit later, but almost always before they get paid again during this pay cycle, and they borrow again. So really what's happening, I think the thing that borrowers often don't understand, and the thing that is what's so insidious and dangerous about this product is the first time they walk into a payday lender, they get new money. They actually get a $300 loan. After that, the second time they walk into a payday lender, they're not getting new money from the payday lender. They are, in essence, borrowing back the money they just paid the payday lender. So if they pay the payday lender $350 today, and then they flip the loan, they get back $300. So every time they flip the loan, every payday, in essence, they're losing $50. But a lot of people think several things. One is they think they're paying a small fee to get their money early. That's one thing that some people think. They don't understand that they're borrowing back their own money, so that if they could keep from reborrowing, they'd actually have $350 in their pocket instead of having to pay the payday lender and then reborrow. I'll give you an example of somebody who called our office years ago when we were first working on payday lending. Payday lending was legal in North Carolina from 1997 until 2001. They practiced with a loophole after that. They made loans until about 2006, and this fellow called our office in 2004, I believe. He had been he borrowed $300 from the payday lender. He had been in that loan for 7 years. They flipped it every month. In his case, the loan was based on his Social Security income. He was what they call they call them sometimes 26ers if you're flipping it every pay period. They like to have you flip it as often as possible. Because he was only flipping it once a month, he had paid $7,000 to basically float a $300 line of credit over these years. But he thought the payday lender was his best friend because they always gave him his money early. He had no idea the true cost of this loan. I sat there talking to him about it, and I said, well, do you realize you've paid $7,000 in interest on this loan? And he was, of course, appalled. He didn't borrow it for an emergency. He borrowed it because he wanted to take a little vacation. So without that vacation, he could save $7,000. So these are the aspects of the payday loan that lead to the trap. This is why you get trapped. So number one, they don't look at whether you can afford the loan. They really, and in fact, as I said earlier, they don't really want you to be able to afford the loan in terms of being able to pay it off and walk away. Extremely high fees, short due date, 2 weeks later, single balloon payment, the whole thing back all at once. And very importantly, they're holding your personal check and they have access to your checking account. So even if you can't really afford to pay them back, they're going to get their money first and you're going to fall behind on other bills and obligations that you have. But not them, because they get paid. They have sort of a super lien against your account because they're holding your personal check and they can cash that check as soon as your paycheck hits the account. So here are two quotes from executives with two large payday lenders. And these show that their intention is to trap you in long-term debt. You've got to get the customer in, work to turn them into a repetitive customer, long-term customer, because that's where the profitability is. A note about rollovers. A rollover is just what you think of as a loan flip. We're convinced the business just doesn't work without them. So usually when I start talking about APRs, it's very easy for people to start glazing over. APRs are irrelevant. They don't make any difference. It's not a loan you hold for a year necessarily. It's a 2-week loan, blah, 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 blah. So I want to just show in dollars and cents so the difference in what you pay for a payday loan versus some other types of loans that you might get. So a payday loan, which is $15, I'm going to use the example of 15 per 100, fairly standard. It's actually a little bit low, according to the national average. Since you're paying that on average every 2 weeks, that is a 390% APR loan. I'm just going to round up to 400% for sake of argument. But these dollars are based on 390. So if you're in that loan for 7 months, which is actually fairly typical, fairly average, you're going to pay $1,000 in interest, and you still owe the $500 that you borrowed. If you're in that loan for a year, sort of like the example I just gave you, the guy who's in loan for 7 years, you're going to pay close to $2,000 in interest, and of course you still owe the $500 principal that you borrowed. Now, if you'd gotten a 28% advance on your credit card, you'd be paying, $76 over the course of 7 months, or $140 over the course of 12 months. If you took out a credit union loan at 18%, which many credit unions are actually capped at that amount, you can see the amounts that you pay for that. There's a credit union in North Carolina, State Employees Credit Union, that makes what they call a salary advance product. They put it on the ground to compete with payday lenders. And when they started offering this product, which is a 12% annual interest rate product, people would come in and say, well, that's not much cheaper than my payday loan because, that's only 15% and you're just giving me 12%. But of course, you can have your CECU loan at 12% annual interest and only pay $65 over the course of a year if you borrow $500. But if you borrow $500 from a payday lender, you're going to pay $75 in interest the first time you go back to flip the loan after 2 weeks. And then, of course, when you pay that $75 26 times, it starts getting pretty ugly. So this is just a short table, a chart from some of the research that we've done at the Center for Responsible Lending. We think of churning as the dynamic where you're flipping the loans over and over again, and really a churn just indicates that you don't have enough money to pay off the loan and walk away without borrowing again quickly, because you need to fill that hole in your that's now missing from what you just got paid as soon as you pay back the payday lender. So the vast majority of payday loans are not loans that are given to somebody because they have a new financial crisis. It's loans that people take out to pay back their last payday loan. So really, your payday loan becomes, every 2 weeks, your payday loan becomes the financial crisis you have to deal with. It doesn't solve it, it creates a new crisis. So this is a typical scenario. This is certainly not worst case scenario. This is the average scenario for a payday borrower across the country. This is based on a combination of research that's been done by our office, it's been done by Pew, that's been done by the new Consumer Financial Protection Bureau. On average, borrowers take out an initial loan and then flip that loan 8 more times. So they are paying, they're in debt for more than $200 to borrow $350. So as I say, it's almost like every time you walk in a new payday shop, you've thrown away $458 because that's what it's going to cost you to take this loan. this is not a solution to your financial crisis. This is really, truly digging you in a deeper and deeper hole. And of course, the consequences are huge. Research shows that if you take a payday loan, as compared to customers in a similar situation that didn't get a payday loan, they even look at people who applied for a payday loan and didn't take it or didn't qualify, you're more likely to overdraft, pay overdraft and bounce check fees. You're more likely to lose your banking account privileges, and that's often because you're racking up a bunch of overdraft and bounce check fees. You're more likely to default on your credit card. You're more likely to file for bankruptcy. And of course, you're more likely to fall behind on the range of other debts you have. So people that I spoke to fell behind on rent and mortgage. They fell behind on all their bills. They didn't qualify for a Habitat home because the debt-to-income ratio was too high. They didn't qualify to cure a default on their home. They quit buying gas. They quit driving their car. They turned off their lights. In some cases, they quit buying food for their family. The consequences are not just financial, they are huge. Nationally, payday loans drain $3.4 billion every year in fees. And as I said before, the vast majority of these fees are just due to people flipping their loan. 22 states, including D.C., have eliminated, either never allowed payday lending or have eliminated it. Not a single state has authorized these 400% payday loans since 2005. When I first started working on this issue, it seemed like a couple states a year would authorize payday lending, and we would just be horrified to think that they were doing it, because in North Carolina, we had sort of worked to get them out, and we're having some real progress in that sense, and it was clear that we were way better off without them. But the tide has turned, and states have really started looking carefully. There are big pushes to authorize. There's been a huge push in Pennsylvania by the payday lenders to authorize pay, and they were actually back in North Carolina this year as well, trying to get their foot in the door back in North Carolina. But no state has authorized since 2005, and a number of states have made steps to either not authorize them at all, roll them back totally, or at least reduce the debt trap associated with payday lending. And this is saving the citizens of these states $2 billion every year that they don't have payday lending in their state.
Just a sentence. I just want to tell everybody, you're sending in great questions, and I'm just going to let Susan get through all of this, and then we'll answer each of them as they came in. So keep them coming. Sorry, Susan.
Okay. No problem. So now I'm switching gear. I am moving to what I said we talked about before, which is banks making payday loans. And in our minds, they're not like a payday loan. They are a payday loan. A payday loan is a payday loan no matter who makes it. And the way this works is they're exactly the same structure as a payday loan. And the fees are not quite as high, but extremely close. The first year we looked at bank payday loans, the average APR on these loans was 365%. Now they've reduced their fees somewhat, and it's down to, on average, 300%. And with one bank, the average fee is 225%. That's as good as it gets, is the average fee, is 225% APR. So what happens is that you're a bank customer. Sometimes they require that you might have been a bank customer for 6 months or so. You have to have direct deposit of your paycheck or your Social Security check or some other benefit check. And you just go online and do a quick click, or call them up, or go to the branch and you say, I want my quick cash. And they deposit the money immediately. And then, of course, when your next deposit hits your account, they repay the loan in full plus the fee. If you, for some reason, don't have a deposit that comes into your account, something goes wrong that month, and you don't know, you lost your job or whatever, they're going to take the money from your account after 35 days. They're going to take the money from your account anyway, even if it overdraws your account and creates overdraft fees for you. So they win both ways. And they actually market these loans as a way to avoid overdraft fees, which is, of course, incredibly ironic because they're the ones charging you the overdraft fees. So who is doing this? These are the 4 biggest banks that are making these loans. Wells Fargo has actually made these loans for decades. It is a newer product for U.S. Bank, Regions Bank, Fifth Third Bank. And there are two other small regional banks, Bank of Oklahoma and Guarantee Bank, that have also introduced the product. They all have nice names for them, you know, Fast Loan, Easy Advance. You can see that they sound really great, but it's an incredibly dangerous and insidious product because people don't expect that their bank is going to be doing something so high cost, particularly when it's not a penalty fee. You know, it's not like you've overdrafted your account. You're just going in to get a loan. So when I was looking up the name for Guarantee Bank, this Easy Advance, what they call their product, I came across their sales pitch online, and just to read it: emergency cash at your fingertips. When life's little emergencies arise, help is on the way. One simple phone call. And they go on to describe how great it is. And it's only, as you can see, the advance fee is 10% of the amount advanced. Well, that sounds like a 10% loan to most people. Sounds like, something pretty reasonable. You go, here's U.S. Bank. You go online, request checking account advance. Wells Fargo, get your direct deposit advance. It's just so easy and so quick. And they don't have to spend any money. They don't have to put up a new storefront. They don't have to spend much money marketing. It's right there. Well, here's what the research shows, and I will say this was a surprise to us, and I hope it's a surprise to you as well. The bank APRs, as I said, these payday loans made by banks, as I said, carry an average APR of 225 to 300%. So the ones that charge $10 per 100 borrowed, on average, you're paying that loan back in 12 days. That's a 300% APR loan. $7.50 per 100 borrowed, pay it back in 12 days. That's a 225% APR loan. Wells Fargo's fee structure is $7.50 per 100. They say, well, these are half the price of payday loans. They're so much better. But of course, they're made by your bank, and people just they don't understand the cost, and they don't assume that the bank is going to be doing these terrible things. And the debt trap is even worse, I think partly because people are so clueless about what's really going on. So the median, like the middle person of all the bank customers getting these loans, took out 13.5 loans in 2011. That's the latest year for which we calculated this data. Over a third of the customers took out more than 20 loans. So the average number of loans per customer is actually higher than 13.5. It's 19 loans is the average number of loans per customer taking out these loans. And on top of that, with these loans, you're, of course, not avoiding overdraft fees. You're twice as likely to incur overdraft fees. And a quarter of the borrowers taking out these bank payday loans are Social Security recipients. The thing that really struck us as we started working on this problem was how hidden it is. People don't understand what's going on. And it's partly because the bank never has to collect money from you, or almost never has to collect money from you. You don't fall behind on this loan because as soon as your deposit comes into the bank, they take their money. And of course, you're not understanding the true cost of the loan. 10 per 100, 750 per 100, that sounds like you're paying 7% or 10% for your money, forgetting the fact that you might do that, on average 19 times in a year, and they're going to take the money anywhere from the next day to 35 days later, but never more than 35 days later. So people are thinking of it, I think, often as a low-cost cash advance, cheaper than my credit card, but in fact it's a very, very, very expensive form of credit. And if people don't realize that they're having trouble with this loan, they're feeling like, well, I'm just getting a lot of overdraft fees, I'm sort of falling behind, and they don't realize that the source of this problem is actually the fact that they took out an advance from their bank. So this shows where banks are making payday loans. They're not doing it in every state. All the states that are brown are states that have bank payday lending. The states that are bright red are states where payday lending is otherwise illegal, and the banks, through a federal banking authority/loophole are making the loans anyway. So you can see some of those red states include Oregon, Montana, Arizona, Colorado, Arkansas, Georgia, Virginia, and Ohio. And up until recently, it also included North Carolina. We went to over here we went to a gray state because last fall we protested in front of the region's bank in the state capital of Raleigh. Our Attorney General, who was very active in pushing payday lending out of the state, spoke up publicly against their product and wrote them letters asking questions about their product. And state legislators also wrote them letters saying, you know, we purposely intend and made a decision that we don't want payday lending in our state, and we don't want you in our state making payday loans. And in January, they pulled their product from North Carolina. But as you can see, they're still making it in other states where payday lending is otherwise illegal.
The gray states are not practicing. Banks aren't doing payday loans. Right.
They're not making loans in those states. That's right. And in North Carolina, there was only, our website shows, and we also just put out, we'll have information about resources later in the program, but not all the states are making them in all, not all the banks are making them in all of these states. But in North Carolina, for instance, only one bank, Regions Bank, had chosen to come into North Carolina with their product. We were extremely, you know, the last couple of years we have been extremely concerned that this product was going to sort of become the new overdraft product. It was going to be viewed as mainstream and ordinary, and it was being heavily pushed by a software company that was selling the software for it. And, you know, they said, well, you're not going to cannibalize your overdraft fees, but you'll get all these additional fees, and we guarantee you'll get more fees than you've ever gotten before, and it's just the greatest thing since sliced bread. And more banks were lining up to enter the market, into this business. And, you know, it's been really hard to sort of make inroads and make people realize that this is a very dangerous product. But the research is starting to really show the abuses, and that's been incredibly important in terms of getting the attention of regulators. So now I'm going to switch to the third product that I wanted to talk about this afternoon, and that's car title loans. This is like a payday loan, but it's secured by your car instead of your personal check. Somebody in our office, she had this phrase, pay and pay, or KYCG, kiss your car goodbye, which is really how car title loans work. Now, this is not a small loan made by a finance company, say at 36%, for instance, secured by your car. This is a loan that is made by a car title lender for a car that you've already paid off, typically. And you'll see the cost of this loan in just a second. And I don't know, you know, I mean, obviously people called in from all over the country. In North Carolina, it's virtually impossible to live without a car. We don't have adequate public transportation. You've got to use your car to get to work. You've got to use your car to get your kids to school, to get to the doctor, to get to the grocery store. You need your car. And car title lending really puts your car at grave risk of being repossessed. So I want to show you how that works. Again, short-term loan, high interest, secured by the title to your car. It's usually a 30-day loan, in this case 300% annual interest. They require clean and clear title to the car in most cases, a spare set of keys, you have a driver's license and a photo ID. They do not necessarily require that you have a bank account or a source of income or employment. So here's the scenario. You know, you drive your car to the car title lending store, you know, with your driver's license, your car title, your spare keys, and, you know, maybe they're going to ask for a recent pay stub, depends. The lender looks to see how much your car is worth and then decides how much they're willing to loan you. You typically go, you know, they give you your cash that they're loaning you. They schedule an appointment for you to come back in a month. And in a month, what typically happens is that you're going to flip the loan because you can't afford to pay off the whole thing and walk away, just like you can't afford to pay off a payday loan and walk away. Now, this is shocking, and this is based on our recent research on car title loans nationally. The average amount that people borrow is higher than a payday loan. $1,042 is the average amount that someone borrows. Typically, just like a payday loan, the loan is typically flipped 8 more times. You take out the initial loan, and then you flip it 8 more times. So and then the fee is $25 per 100 for the month. So that means that over the course of this 9-loan cycle, which is, again, the average car title scenario, you're going to pay over $2,000 in interest to borrow $1,000. So you're paying twice as much in interest as what you borrowed. And then, of course, you owe back the principal you borrowed as well. The average car being put up as collateral on this loan is worth $4,000. So they've given you a $1,000 loan on an asset that is worth $4,000. Here is, again, what we call asset-based lending. I think you folks are probably most familiar with this in the context of home lending when they made home loans you couldn't afford because they had your house as collateral. So if it goes under, they get the house. We all know that scenario way too well. And look at some of this. Qualifications, job, only if your car is worth less than $2,000 in value. If not, you don't need a job. Bad credit, okay. Bankruptcy, okay. Non-conventional salary, okay. I mean, it's just a quick cash scheme. So car title lenders operate in 21 states. They're making about 2 million loans every year, and they're lending out about $2 billion every year, and they're collecting in over $4 billion in fees. And add on top of that the fact that everybody who takes out a loan is at threat of having their car repossessed, and 1 out of 6 borrowers actually pay repossession fees, which can run $350, $400. They're usually about half the amount of the loan balance. Very high fees. So this is where they're available. Red states. 30 states prohibit car title lending, and I'm happy to say North Carolina is one of those. We've never allowed car title lending here, even though they tried to pass a bill this year to allow it. But they do operate in the other 21 states, and 17 of these red states explicitly authorize car title lending. They've said, come on in, no problem, and they don't even set any limits on the interest or fees that can be charged. In 4 of the states, they actually are just using some loophole in the state lending laws to make car title loans. That's true in Louisiana, where they're using a sort of a loophole in a small loan law. Louisiana legislators voted against car title lending, but they're there anyway with this loophole. It's true in South Carolina. In South Carolina, they just have to make sure the loan is over $600, and then they can use a loophole. In California, the loan has to be over $2,500, and they can use a loophole. And in Kansas, they just call it an open-end loan, and that creates a loophole for them. And Texas has loopholes as well around things called credit service organizations. So states are starting to get wind of the problem. Some states have recently banned or lowered the rate caps on these loans. They're most concentrated. It was interesting to see that so many people were calling in from the South, because all of these products are really, they're worst in the South. Mississippi, Alabama, Georgia, Tennessee, these states, South Carolina, have often the worst costs and patterns around these forms of predatory lending. I grew up in Alabama, and every time I'd go visit my parents, I'd see car title lenders, payday lenders, and every other bad lender in the world on virtually every corner. I'm going to speed it up a little bit here because I know everybody wants to get to some questions, but I will have a few slides on sort of the regulatory structure and what's happening to rein in these abuses, and then a little bit on how you might help your clients. Used to be that we had clear usury caps. these high-cost products really didn't exist. They weren't legal. They weren't on the ground. They didn't have these storefronts everywhere up until about the 1990s. They were prohibited by our small loan laws. And then the payday lenders, car title lenders, banks didn't bother to go to the states, but they didn't need to. But these other high-cost lenders, basically hired lobbyists, went to the state legislators and said, we just want to make this quick emergency loan. Nobody's making loans to these poor people anyway, and we need to help them with their financial crisis. And so it's just going to be a one-time emergency, quick financial fix, and it's all over. It's just $15 per 100, no problem. And a lot of legislators, of course, as you can see, went along with that scenario. But the tide is truly turning. And as I said earlier, no state has authorized since 2005. Some states have clearly kicked them out. Arizona, Montana, and Ohio had ballot measures, and the voters overwhelmingly voted against payday, despite being outspent sometimes 30-1 on the ballot campaign, with the industry people spending so much money to get the message across. The federal government shut down what we call rent-a-bank. They were operating in North Carolina for 5 years using a rent-a-bank model. They'd affiliate with the state with the banks that was based outside of North Carolina and say the bank was making the loan, not the payday lender, and the federal regulators shut that down. The federal government, Congress in 2006, under the Bush administration, they passed protections for active duty military and their dependents that capped their loans at 36%. And now we're in a situation where 22 states prohibit or seriously limit payday lending, and that's only going in the right direction. And here's what else is happening with these loans. So now we have a federal regulator. For the first time ever, with the Financial Reform Act that was passed in 2010, for the first time ever, we have a federal regulator who, number one, is charged with looking at financial products to see are they safe for the consumer, and number two, they have the power to regulate payday and car title lending. Now, it's taken them several years to get up to speed, and it's also taken several years for them to get their full authorities because Congress was keeping the CFPB director from final confirmation for a long time, but he has been confirmed. They do have their full authorities now, and they are looking very closely at these high-cost products. They understand the abuses. State legislators also starting to look very closely, looking at ways to either totally get rid of the product or at least put in restrictions that cut down on the flips. The Military Lending Act hit some loopholes. They're looking now, DOD is looking now to close some of those, looking at what they need to do to close them. And state and federal regulators are also strongly enforcing against anyone who's trying to come into their state illegally. So when I say a state, like in North Carolina, when I say payday lending is illegal in North Carolina, it is illegal for everybody. And that means it's illegal for an online lender based out of the state or out of the country even, come into our state and make a loan over the internet. Those are illegal as well. And New York particularly, New York has particular enforcement authorities, has aggressively gone after online lenders, but a whole bunch of states, other states have as well, and that those attempts are just getting stronger and stronger. The regulators are sort of fed up with these attempts to get around state and federal law. Now, bank payday lending is different. This is not, as we said, not regulated at the state level. This is wherever they want to do it, where there's a bank, and because it's outside of the state usury caps generally. So you saw the map for where they're making loans where they would otherwise be illegal. Now, the good news is that the OCC and the FDIC, who are what we call prudential regulators for 4 of those banks making payday loans, have proposed guidance that would really stop these abuses. Their guidance says you got to consider ability to repay. You can't make a loan based on the fact that there's just going to be a deposit coming into the account and you can take it. That is not good lending, and we expect this guidance to be finalized very soon, and that could easily serve to change the lending model to a point where it's significantly less abusive or actually drop the loans, have the banks drop these loans altogether. The Federal Reserve, who has authority over the other two banks, is also concerned and looking for ways to regulate, even though they haven't been as strong yet as the OCC or the FDIC. And CFPB has been fabulous on payday lending. They looked at, and bank payday lending, they put out a big study which looked at 15 million payday loans and documented the debt trap for those, and looked at tens of thousands of bank payday transactions as well, and documented the debt trap for bank payday loans. So they're carefully looking at these products as well. Now, I know that Rita said, well, these people really need these loans. Don't they sometimes need them? Aren't they better than the alternatives? I would say any alternative is better than a payday loan, a bank payday loan, or a car title loan. If you've got borrowers that are basically trying to make ends meet at the end of the month and coming up short, which is the typical scenario for a borrower, it's not like a one-time emergency. They just don't have enough income. Going in debt at 200, 300, 400, and sometimes higher percent APR is not going to solve their problem. It's just going to dig their hole deeper. And for the few fraction, the 2% of the people who can take one of these loans and pay it off, 98% of the people are trapped. Now Pew has done some excellent work on payday lending, studying borrowers, studying their patterns, what's the demographics, why do they take out the loan, etc. And they asked borrowers, if you couldn't get a payday loan, what would you do? And the vast majority of them said, well, I'd cut back on my expenses, I'd delay paying a bill, I'd borrow from friends and family, I'd sell or pawn something. Some people have savings accounts they don't tap into. They could take money out of a savings account. And these are all things that people actually end up doing anyway when they get in payday debt, because they have to get out of debt somehow, and these are the same things they do to get out of payday debt, or car title debt or whatever. But of course, when they've been in the high-cost debt, they're in such a deeper hole because they've paid all this money during the course of months or years that they've been in these bad loans. In North Carolina, we had a study that also looked at the cost of sort of asked borrowers after the fact, better off payday lending was on the ground here, and then it left. Overwhelmingly, people said we're better off without it. And that was a study that was commissioned by our Commissioner of Banks and done by University of North Carolina. So, helping your clients and fighting these abuses. So at the policy level, and these are what these two links are, you can sign up to get our national, or specifically for California, newsletters from CRL. We'd love to add you to these lists. Just go on our website and please sign up. If you live in North Carolina, I encourage you to join the coalition. There's the link to the North Carolina Coalition. And really, I've come to believe over many years the only way to really solve this problem for your clients is to make these products illegal. They are abusive products. If these were exploding toasters, they would have been pulled off the market 15 years ago. It's just been that our financial products have been poorly regulated from the perspective of consumers. We could talk more about getting your clients out of debt if they're in debt. It's an extremely hard thing to do when payday is legal in your state, but we can talk about that more, and that's probably part of the questions that you might have. And that is it for me. So I am going to turn back over to Rita, and I apologize for taking us so close to the end here.
Just go ahead and send it back to me. Okay. Okay, let's see. Oh, Susan, it was wonderful. I thank you so much. I thought it was really important to get all of your information in. I know some people always have to leave at the end of the hour, and I apologize for that, but it was great, and I think that everyone on the call really appreciated your expertise. So before we get to questions, I did want to spend just 1 minute for those of you who are new to financial social work. I mentioned before that our goal is to help men and women take control of their money and gain control of their lives. We do that through our certification program, and up on the screen it tells you, what that's all about, and I'm just going to stay on this slide for a few seconds. We do give NASW National gives 20 CEs for our course. And the reason we think it's important is because it does help people change their behavior. And if we really want to advocate for clients, we can do that on the state and the national level, but we also have to help clients understand why payday loans don't work and give them the tools and the skills and the understanding and insight to be able to make other choices, better choices. We also have a client program. All of these things are on our website. And by using the client program, you don't have to recreate the wheel. We have everything clients need to know and to do to help them begin the journey to a better financial future. I want to thank all of you for joining, and now we have a lot of questions. So on this slide, I put up Susan's contact information, our contact information. We do regular webinars. And we are on Facebook. Susan, the Center for Responsibility is on Twitter. I know you must be on Facebook. So we are out there fighting the good fight, everybody. So follow us, join us, and let's go to the top with the questions. Okay, Susan, what advice can you offer for elderly clients with reverse mortgages?
Wow. We've heard increasingly that reverse mortgages are the new predatory mortgage loan of the future. I think I don't want to get into this in any great detail because it's a very complicated issue, but our website has information about reverse mortgages on. Another excellent source is AARP's website. Reverse mortgages can be a good strategy, but often they are extremely expensive and sold inappropriately. So I think I would be very wary about advising seniors to take these loans unless somebody was guiding them carefully through the process who understood the true cost of and the true structure of the loans.
Excellent advice for sure. I think that anyone paying attention this past hour knows that if it sounds too good to be true, it usually is, and that there's always a lot to know before signing on any line. Quite a few of you asked if the presentation would be available to you. The recording will be available to you. You will all receive it via email, and that way you can go through it slowly. A couple of you said you couldn't keep up with all the statistics. You'll be able to stop it and copy those statistics. Somebody shared with us that she was joining us, he or she was joining us from Alberta, Canada today. Okay. Susan, does the center also look into governmental abuses, basically trapping SSI or SSD recipients and denying them wealth building?
We have not looked at that. We really focus on, and I think because there's so many lending abuses, we have focused on a lot of issues, overdraft, credit cards, a lot on mortgage lending. We were one of the first groups to say in 2006 we're going to be facing a huge foreclosure crisis, but not the issues that you just raised.
Okay. Does the Center for Responsible Lending loan clients money to get out from under car title loans?
We do not. We are not a lender. Self-help is a lender, but self-help, as I mentioned earlier, self-help is an unusual type of lender. We do mostly home loans and business loans, even though we have actually started a new sort of retail credit union presence. I would say, I would give you the example. There is the State Employees Credit Union, which I mentioned during the presentation. They loaned several people. They sent us loan documents for several people who've gotten caught in car title loans, and they lowered the interest rates for those people from 300% to 4%.
Whoa!
They did refinance. Yeah. So I think it's worth. You got to get out of these loans if you're in them. There's no way you're going to be able to sustain this, this debt. So, but CRL is not a lender.
Well, I knew that, but I needed you to explain it. And anybody, we still have a couple hundred people left on the call, and we will go through these questions. But one of the things that that I think we should point out is what we really want to do is keep people from getting into them. Now, we know that isn't easy, but in one of my discussions with Susan, she made the point that once you get into it, it's next to impossible to get out of it. So what can we do? We want to prevent people from taking them in the first place. Go ahead.
I mean, I would say the only way to prevent people from taking these loans is to make the loans illegal. If the loans are available, people will take them because they have a financial crisis and it looks like a quick solution. So really the only way to truly prevent clients from getting into trouble with these loans is to be sure that the loans all become illegal all across the country.
And I'm sure that those of you still on the call and everybody else who joined us through the presentation, are feeling frustrated. Well, I can't do that on my own. We can't do that. I think it was Eleanor Roosevelt who said something about one person. We can do a lot, but we also have to incorporate this information into the work we do one-on-one with clients. And I know it's frustrating because often the clients are already caught up in it, and there is so little that can be done to get them out of it. But I thought that it would be empowering to hear this information for everyone and to be more knowledgeable. So are there any positive alternatives to payday lenders, i.e. low-interest nonprofit lenders?
Most, contrary to popular opinion, a lot of banks and also credit unions do make small loans. The problem with a payday loan or a car title loan, for instance, is that a responsible lender is only going to make that loan if the borrower can afford to repay it, because they're not going to take this super lien position. So you can't really compete with payday lenders. I mean, there are lots of, faith-based groups that make loans. There are a bunch of military relief organizations that, not only make loans, but, give free money. There are all sorts of other groups and other places. But I think one thing that's very important to remember is that even if there's nobody else making a loan, you need to get rid of these products because these loans don't help. So, and most of the people that are getting these loans really can't sustain any more debt. They were over their heads in debt already. So an additional loan, even at a reasonable rate, even at a low cost, is not necessarily going to help them because they're already not making ends meet with the debt they have. So I know that we often are getting people, and when they're legal in North Carolina, we're often getting people in touch with credit counselors. We would try to do workout plans. I mean, every payday lender says their best practice is to do a workout plan with somebody, do a repayment plan, even though they fight hard not to do them because they want people to stay in debt. But I think the goal is to get people out of the payday loan and not worry so much about what other loan is around the corner, because those are not going to solve their problem.
Great advice. Okay. Is it advisable to let the car go to stop the cycle of debt with a car title loan?
Whoa, it depends on what your car is worth. I mean, if your car is worth not very much, it could be. But most people don't feel like they can give up their car. It may be too expensive to get it back from the car title lender. But usually, since the average, I think I didn't mention this, the average, well, I did, but I didn't really spell it out. With the average loan of only $1,000, your car's worth $4,000. So you don't want to give up an asset worth $4,000 to repay a loan worth $1,000, even if it gets you out of the debt trap. So I would try first to do what the borrowers I just mentioned did, which is try to see if somebody else will give you a loan for $1,000 at a reasonable interest rate that you can then use to pay off the car title lender. I would certainly do that before I'd give up my car.
Does an online payday lender need to honor state laws banning such loans?
Yes.
Yes, that sounded like your answer. 400% interest rate or APR? Mm-hmm. Yeah, that's a question.
It's a 400, an annualized interest rate is the APR. So that's looking at and the APRs are designed to allow you to compare the cost of a loan across different loan products. So, if you've got if you're putting money on your credit card, or you're putting money on, you're getting a car loan, or you're getting a mortgage, or you're getting all these different loans, you need to be able to look at what's the real cost to me of this loan product. And because the lenders can be very deceptive in how they present their information to you verbally, there's this requirement from the federal government that they have this standard form, which is requiring them to say what's the annual percent interest rate. So the interest rate, you might say the interest rate, the pure interest rate is 1,500, say on a payday loan, but the annualized interest rate, because you're going to pay that 26 times over the course of the year, is 400%. And if you take, anytime it's 100%, if you have a 100% loan, you're going to pay, or 200% loan, you're going to pay twice as much in interest as the amount you borrowed. If you have a 400% loan, you're going to pay 4 times the amount in interest of what you borrowed if you're in that loan for the course of a year. But the APR is still relevant even if you're only in the loan for 2 weeks, because it helps you standardize the cost of the credit. It's a confusing concept, and I'm sorry for that.
Are not payday lenders getting around excessive interest rate restrictions by charging fees at closing, management fees, or some other administrative fees?
Typically not. Payday lenders are a pretty straight fee structure, and they load the fees. I mean, they call it a fee. We call it interest. And they used to say we're not subject to truth in lending or APRs because we're not charging interest, we're just charging a fee. But they were overruled on that, and people said, look, this is the cost of borrowing money. Then they said for a while, we're not loaning money, we're renting money. They actually said that, we're renting money.
Wow.
That was but usually they don't pack it with other fees. Other lenders often do, but these particular lenders, it's a pretty straightforward product. And really, when you're charging 200, 300, 400% APR, you don't need to pack in other fees. And they like to pride themselves on the fact that people understand the cost of the loan because it's so simple, so they don't tend to pack in other fees.
A couple of people asked, how do payday loan companies target the elderly on fixed incomes?
We've heard that they locate close to like senior housing projects. Once a senior goes in the door to a payday shop, it is incredibly hard for them to pay off that loan because they don't have the ability to get another job, to supplement their income. They're just caught. I talked to some people who worked at payday shops here a long time ago, and they said that a big portion of their borrowers were seniors. The Pew study has more information about the demographics of borrowers, and I think for seniors, the tricky part, of course, is that they're living on, so many of them are living on so little income to begin with, through the Social Security check, that even taking $50 a month is a lot of money. One thing I didn't talk about is the dynamic where a lot of people get into, they take a payday loan and then they can't pay it off at the end of the pay cycle. So they take another payday loan to pay back the first payday loan, and then they take a third payday loan to pay back the second payday loan. And I talked to a senior woman actually who was living on her Social Security income. She was the first person who came to me with a payday loan. She had she borrowed $100. She had no other debt. She borrowed $100 from the first payday shop, and then she ended up taking out 5 more loans because she couldn't afford to pay them off without reborrowing from somebody new. And she ended up paying half of her Social Security income in rollover interest every month. And we lost track of her. I think she got kicked out of her apartment. She'd already cut off her phone. Her phone had been cut off. She'd gone to a church for emergency help. She'd gone to social services for emergency help. And we, after we talked to her, we lost track of her. We could never get in touch with her again. And I think she probably got kicked out of her apartment. So far behind.
And there actually is, I don't know if there's more than one, but there is a Payday Lenders Association with very specific language to address the working poor, and they separate that out from the elderly. And so they have very specific language and approaches to both of those populations. It's unbelievable. So clients who get their loans, oh, go ahead, Susan, you want to say something?
Well, that reminded me that we also saw people who were getting payday loans secured by their unemployment check.
No, right. Oh, how do payday loan companies work with borrowers on a debt management plan?
They don't. They try very hard not to, because they don't want you to pay off the debt. They want you to have to flip the loan. They structured it so that the loan, the loan flip is just under what you pay if you bounce the check, if you defaulted on the loan and bounce the check, which actually is better to do. In some cases, and that might be, with the car title loan, it's a different scenario because you can lose your car. You could lose your banking privileges as well with a payday loan if you rack up a whole bunch of overdraft fees. But they structure it so that the cheapest thing you can do at the end, when the loan comes due, is to flip the loan, and they try very hard not to do any repayment plan with you, and they've tried very hard not to work with credit counselors that are working on a repayment plan.
Someone wants to know the legal definition of predatory lending.
There is no legal definition, no single legal definition. I think of predatory loans as loans that strip home equity or family wealth, and really they're designed to do that. They include abusive features that are designed to strip home equity and your other family wealth or income. But legal definitions are, of course, structured in law, and predatory loans are regulated by literally hundreds, if not thousands, of different state and federal laws.
With the title loans, if the consumer does not return to pay for the loan and the car was worth less than what the title company anticipated, will they go after the consumer for the balance?
Yes, often. And that, again, that's dependent on how the state law is written. If it's a state that specifically authorizes car title lending, it says how they handle what they call the sort of the deficiency judgment. If that's the case, I think they tend to handle that at the front end by only loaning you a fraction of what the car is actually worth. And then the other scenario is that they're not, even though, for instance, with our example, you're sitting on a car that's worth $4,000. That's your car. They made your loan for $1,000. Even if you default on your $1,000 loan, it's very unlikely they're getting the extra money, right? They're getting $3,000 extra dollars in addition to whatever you paid in interest. But under most state laws, you're not going to see, as the borrower, you're not going to see any refund to you if you defaulted on that loan for the extra collateral they have taken on your debts. Does that make sense? I'm maybe not explaining that very well, but so instance, you can lose your $4,000 car for a $1,000 loan and get none of that extra $3,000 back.
That's the way it's designed, for sure. In El Paso, there was a city ordinance passed to limit the negative impact of payday car title loans. Are there similar initiatives in other American cities?
Texas has been particularly active in terms of passing local ordinances. There's some in California. There's some in other states. Of course, you only need those in a state where you've got these problem products on the ground. There would be no reason to pass them in North Carolina, for instance. But I would say Texas and California are probably the most active states in terms of local ordinances.
Is the Payday Support Center a good alternative or way to get out of payday loan cycles?
I don't know what the Payday Support Center is. What is that?
I don't know. Maureen, if you want to give me that information, we can share it. Can you give any more details about what the loopholes in the Military Lending Act are?
The Military Lending Act did not cover open-end loans. So the Military Lending Act actually sort of covered, primarily focused on three types of loans: payday loans, car title loans, and refund anticipation loans were the three loan products that they particularly focused on, and said these loans can't be more than 36% APR. And actually theirs is their own unique little APR that they calculate, which does include any other extra add-on fees and products. It's a very tight APR equation. And but they talked about loans of a certain size or loans of a certain length or loans that were closed-end, and so it's easy to organize these loans as open-end loans. For instance, the bank loans, bank payday loans, are all technically presented as an open-end line of credit. So those, in theory, are not covered by the Military Lending Act now, and that's the type of thing that they're looking to see. How do we really cover all these abusive products, knowing how they can get around our original regulations.
If someone is a resident of a state where payday loans are illegal, like North Carolina, can they receive a payday loan or bank payday loan in another state, like South Carolina?
Yes, they can. And people in North Carolina certainly go to adjacent states and get loans. They cannot use the North Carolina courts to collect on those loans, but they still can create pretty big havoc for borrowers, that have taken out a loan and can't afford, if they can't afford to repay it, or if they get caught in the debt trap, of course. Yes, the people do cross state lines to get loans, and in fact, the payday lenders encourage that. They sit on all the borders of all the states that are where the loans are legal. So if you're, in Pennsylvania and going to Delaware, you'll see a whole bunch of car title lenders, or North Carolina into South Carolina, you'll see a bunch of payday lenders or car title lenders.
On the statistic that the typical payday loan borrower is in debt more than 200 days per year, is that in debt to the actual payday loan provider?
Yes. That means you're actively in a payday loan for that number of days in the year, on average.
All right, we are coming.
Could be in debt. You could be in debt, of course, the whole year, or you could be in debt for, a week or two. But the week or two scenario almost never happens. The 200 days is the average, is the typical borrower.
Okay, I'm in Idaho, and many that I work with are tribal members. I'm now seeing tribal members being targeted by online tribal lending companies. Are these tribal lenders really tribal companies?
I'm gonna not give you a very informed answer about that. There's some people on our staff that actually know a huge amount about tribal lending, and I am not one of them. But I would say, in general, they are not truly tribal lenders. They are presenting themselves as if they're tribal lenders and using that as a loophole to not have to comply with state laws. But there has been aggressive action against these tribal lenders, and it's something that will probably be handled at the federal level, because states. The federal level is the group that is the government level that could actually rein in tribal abuses.
I've read that what you're saying, that these really are banks using the tribal name, but we won't answer that one. Okay, someone wrote, she understands the idea of profit, but what kind of a person or corporation would knowingly put people already in dire straits in more financial trouble? It smacks of immorality and lack of integrity, and she closed her Wells Fargo account due to this practice. All right.
Oh.
Yes, proactive. How do you prohibit someone from a restrictive state from going online to get a payday? Right. Well, we kind of just answered that. Do you know?
Well, you don't really. I mean, they can go online and get one. I mean, in some cases, for instance, if I went online to some of the big payday lenders and I said, I live in Durham, North Carolina, they'd say, our loans are not available to you. But other lenders would make loans to me in North Carolina. So it depends on the lender. And yet, if I get caught, and this is a very important thing I think for your members to know, if you've got clients that are caught in an internet payday loan, and payday lending is not legal in your state, I would automatically file a complaint with the Attorney General's office, work with them to do that, and the Attorney General's office is probably going to advise them that they're not required to repay the loan. I mean, they may. So they should go with the advice of the AG's office, and the AG can also send a cease and desist letter to that online lender saying you've made an illegal loan in our state. It is not legal or enforceable. So don't have people in online loans paying them if those loans are illegal in your state. Please get your Attorney General involved in handling those situations.
Well, that's a question that was asked, and that person is still on the line. She wants to know, who do you complain to? The Attorney General, you said. What about the Consumer Financial Protection Bureau?
I would complain to, if it's got the energy, I'd complain to both. I think, and you might also, file a complaint with a sort of a, depending on who regulates them. I mean, if it's a regulated industry in your state, for instance, if you're having trouble with a group that's regulated, you could complain with the group that regulates them. Like in North Carolina, that might be a commissioner of banks if it were a finance company or something like that. Otherwise, I would complain for if it's an illegal loan, I would go straight to the state AG, and I think it's also fabulous to send something to the CFPB in DC as well.
How are payday loans treated in bankruptcy?
They try to collect. It's the payday loan. The amount they've lent you is so small. It's $350 on average. They'll still try to collect in bankruptcy court if you file bankruptcy, but it's not a. They get their real money from the rollover fees. They give out their first loan often to entice people in to get them in the debt trap. They'll give out their first loan for free, no interest. Come in, get your free loan, because they want you in the door, and then they're going to flip the loan over and over and over again. So, but they're treated like any other creditor. Now, if you were in North Carolina and you had an online payday loan, I think the bankruptcy judge might say, forget it. You don't have any. I mean, I don't think the online lenders are going to try to file in court, but the storefront lenders certainly would in states where payday is legal.
One of my clients who's caught up in the payday loan was contacted by the Payday Support Center, who told her that they would consolidate her payday loans and she would not owe as much and would not pay the payday loans anymore, but would only pay them. Well, I don't know. Something about that doesn't sound right. What do you think?
Yeah, I don't think that sounds too good to me either. I'm going to go Google them as soon as we get off. I've never heard of them, and I doubt if. My rule of thumb with lenders is if a lender is contacting you, you better beware, because they got something to sell you, and if they've got enough extra money they're making from their from their loans to be able to market out to you in that way, that's a dangerous sign. My gut instinct is that's another scam.
I think so too, but she gave us the website, which is help.paydaysupportcenter.com, and a phone number, which is 800-379-6148. Someone wrote, in California, Department of Business Oversight. I'm guessing that's where you report a problem or an abuse.
Yeah, in California, there are different regulators in different states, and California also has something like the Department of Corporations. I'm not exactly sure who the regulator to report the complaints would be, but I know the Attorney General is, sort of interested in this issue, and there have been some legislative battles about payday lending in California as well, trying to rein in the abuses. Well, the lenders are trying to make the loans larger, and everybody else is trying to rein in the abuses.
Well, there are other questions, but some of those people have left according to the question box. So I am going to thank you so much, Susan, for everyone who attended. And some of you joined late because you were from the West Coast and didn't understand the time difference. I'm happy to tell you that you will receive the recording before the end of the week, so you'll be able to watch it, and then you'll have the information you missed. Sorry about the time thing. A couple people have written in thanking us, saying what an excellent webinar it was. And I thank you, Susan. I thank everyone for attending. You were really a great audience. And watch out for a notice on next month's webinar when we'll have a special surprise for you. And everybody, enjoy your day. Bye now.
Thank you, Rita. Thanks for organizing it.
Thank you.